Hello. Today I have something a little different for you. I'm going to review a trading strategy. I review a lot of strategies, and recently I received links to two strategies that I thought were very interesting. So I thought it would be a good idea to video one of these and share it with you. First, to be clear, this is not one of my strategies that I'm reviewing. This is a strategy created by someone else. The author calls this Tim's Moving Average Cross. You should follow the links and view the strategy yourself for complete information. I have no association with the author of this strategy, and I won't be going into detail on how to use and operate the strategy. That's covered very well by the original author, and I've included a link here and in the description below. You should go and see the original strategy for yourself. If you'd like to see more videos like this, remember to click the subscribe button and click the bell icon to be notified when more videos are released. This is what we're going to be covering today. The basic trading rules, just in summary. I'm not going to go into detail on the strategy. As I said, you should go and view the strategy on the author's original post. Going to look at any ambiguities in the way the strategy is described. I'm going to look at problems, particularly focusing on how this strategy can be used if you're trading on MetaTrader. I'm going to then go through setting up the charts in MetaTrader to run this strategy, how easy it is to understand the strategy, how suitable it might be for manual trading, how suitable it would be then for automated trading, and finally we're going to look at some backtest results that I've created. As I said, I won't be describing the strategy in detail. I do have to show you the basic trading rules to put things into context. The strategy uses the 100 period SMA and the 20 period EMA as a trend filter. So I know that the strategy is called Moving Average Cross, but the author does point out that it's actually a trend filter that the moving averages form. You only buy when the EMA is above the SMA and only sell when the EMA is below the SMA. Next, we buy when a candle opens below the EMA and closes above, and we sell when a candle opens above the EMA and closes below. We use the ATR and do not trade on a candle if the price has moved more than one ATR from the EMA. Do not trade if the volume for the candle is less than 75% of the average volume, and only trade a half of your normal lot size if the volume is between 75% and 100% of the average volume. Take profit is set at 1 ATR from the entry point and stop loss at 1.5 ATR from the entry point. If the next candle after opening the trade closes on the opposite side of the EMA, then close the trade. At the take profit point, close half of the trade, move the stop loss for the remainder of the trade to the break-even point, and then implement a trailing stop. And the author leaves the choice of trailing stop to you. Now the ambiguous parts of the strategy, and I could only see one. It's the ATR rule. The original strategy isn't clear if the movement of a candle by more than one ATR applies only in the direction of the trade or in either direction. The examples the author gives on the strategy only cover cases where the ATR has moved in the direction of the trade. So I've taken the assumption that that is where the rule should be applied for my review. To look at the problems, and specifically for MetaTrader users, in the original strategy, Tim is using TradingView.com, and some of the indicators there are different to MetaTrader indicators. The problem we face is with average volume, and there are two issues with volume in MetaTrader. Firstly, volume is not what you might expect. It's not a true measure of actual lots and amount traded. Because foreign exchange is an over-the-counter product, the broker only has a view of their own trades. So the volume indicator in MetaTrader counts ticks during a candle and not the size of the trades. Secondly, MetaTrader does not have an average volume indicator. You have to add one yourself, and when I show you how to set up the charts, I'll go through how to do that. First, let's deal with the volume. The volume indicator itself is easy enough, but we also want an average volume indicator, and MetaTrader doesn't have an average volume indicator. So first thing we do is add a volume indicator to the chart, either from the menu or from the toolbar. Next, we drag the moving average indicator from the navigator panel into the volume window. Don't use the menu or the toolbar to add the moving average, because that will place the average on the main window and we want it on the volume window. And then in the Apply To, select Previous Indicators Data, and that will create a moving average of the volume data. The rest of the indicators are standard. First we had the 100 period simple moving average, now the 20 period exponential moving average, now the 14 period ATR. And that's everything you need on the screen. Now let's look at how easy this strategy is to understand. The rules are clear, nothing subjective in them, and the only ambiguity is the ATR, which we've already discussed. There is a small problem with the average volume due to MetaTrader, and I've already spoken about that, but that appears to be used to indicate strength of movement, and so the tick count used by MetaTrader is probably sufficient. The numbers used for the SMA and the EMA are sensible numbers. I always look for unusual numbers in these kind of indicators because that can often be a signal that the author has used curve fitting to come up with a strategy. Altogether, this strategy is well described and easy to follow. So how suitable is this strategy for manual trading? The strategy is designed for daily trading, so all the work is done once per day. Take profit and stop loss are both set when the trade is entered, so with one small exception, there's no need to monitor the trade once it's been placed. The one exception is the rule to take profit on half the trade at the take profit point. That point could be reached any time, day or night, and unless you're going to watch the charts 24 hours a day, you may not be there when that point is reached. The take profit rule also says to implement a trading stop, so depending on the type of trailing stop you implement, you may have to use some level of automation to maintain that. Just remember though that if you want to trade a different time frame, say 4 hourly, then the ends of those time frames may be at times when you're not watching the charts. This strategy was very easy to implement as an automated trading strategy. The rules are easy to follow and they're very easy for a machine to understand. The use of automated trading also removes the one issue about watching the charts for that take profit point when it's reached. But the strategy may not be suitable for automated trading, and I'll cover that after we look at the backtest results. To backtest this strategy, I built a trading robot and set the trading parameters exactly as described in the strategy, including my assumption about the ATR limit. I ran the backtest in MetaTrader 4 from January to December 2019 for a number of major currencies, and I included Aussie yen, pound yen and Aussie Swiss because they were specifically mentioned in the strategy description. The results were mixed, but I wouldn't take that as an indication of a problem with the strategy. It's more an indication that it may not be suitable for automated trading. The losses in the backtests mostly occurred in periods of a narrow range. If you trade manually, you may consider the trend more carefully before entering the trade. I know that when I reviewed the charts where these losses occurred, quite often I felt that I would not have taken a trade at that point. Also, backtests are not reliable performance indicators for many reasons. In these tests, the modeling quality was not good, and that may have had an impact on the results. Also, the results can be easily influenced by different data, and I know that if you have a different broker to mine, your prices will be slightly different, volumes will be different, and that will affect any results that you might see. That's all for this strategy. I found it a very interesting strategy, and I think it's worth you investigating it for yourself and coming to your own conclusions. I've also placed a link in the description where you can download my backtest results and view them for yourself. For a short time, I'm also going to continue to run a custom indicator and post the daily alerts from that indicator on our website. The alert page only shows the most recent alerts, and there's a link to the alert page in the description. You will need to register for free membership to download the backtest results or to access the alerts. I'm very interested to know if you found this useful, so please leave comments below or on our website. Thank you for watching. Goodbye.